Thank you, Kajal Madam, for this introduction and happy morning to each one of you. Good morning to each one of you. So Kajal Madam has nicely explained the history of emergence of the concept of a registered valuer in India. So as we all are aware, the Companies Act 2013, the current Companies Act 2013, that came into effect from 2013 onwards. But certain sections of the Companies Act 2013 were not notified by the government of India or were not implemented immediately after making effective the Companies Act 2013. So in the meantime, the IBC, Insolvency and Bankruptcy Code, that came into existence, as we all are aware, effective from 1st of December 2016. And under IBC, when actually application for a CIRP were admitted by the adjudicating authority or NCLT, and when valuers were appointed for evaluation of the assets of the corporate debtor. So at that time, it was realized that the value of the asset has been deteriorated to a very large extent. And there was actually a difference in valuation. So that difference was very huge. Value of asset which bank or a financial institution recognized at the time of giving a loan to its customer. So that value was much higher than the actual value that was estimated at the time when companies went into the CIRP process. So this issue was highlighted by the authority or the IBBI, as Kajal Madam informed, the IBBI or Insolvency and Bankruptcy Board of India or IBBI, that is recognized as the authority under the Companies Act and rules made thereunder. So this issue IBBI highlighted before the government of India. Okay, there is a need for actually regulating the profession of valuation in India. So before that, actually, there was no single regulatory authority for the valuers. So this need was highlighted by the IBBI before government of India, and consequently effective from October 2017 onward, the chapter 17 or section 247 of the Companies Act. So chapter 17 of the Companies Act has only one section, that is section 247. That was finally notified, and that is how the concept of registered valuer came into existence in India. And thereafter it was made mandatory that under the provisions of Companies Act 2013, wherever valuation is required, so that valuation will be done only by the registered valuer. And since there was no regulator, so as a stopgap arrangement or as an interim measure, the IBBI or Insolvency and Bankruptcy Board of India, that was recognized as the authority, and they were given the powers of a regulator. And thereafter, as we are aware, in 2020, government has also introduced a valuation bill 2020 in Parliament, but that bill is not passed and act has not been made so far. That bill is pending before the Parliament for a period of nearly 3 years now. So we hope that bill is passed and the new regulatory authority for valuation is created, and going forward, we may get more and more opportunity for valuation. So presently, under all provisions of the Companies Act, valuation is required by the registered valuer. And under IBC also, Insolvency and Bankruptcy Code, wherever valuation is required, so that valuation will be done only through registered valuer, and that came into existence as Kajal Madam informed, effective from February 2018 onwards. So that is how we have selected this particular topic, because the law provision under these two acts are very important, and a majority of the assignment which come to the registered valuer are with reference to provisions of these acts. So with that brief introduction, I will share my PPT. So just give me a minute. So I hope my PPT is visible to each one of you. If you face any issue in visibility of my PPT, just inform me. So a valuation under IBC 2016 and Companies Act 2013, that is our today's topic of discussion. So this is the brief history of valuation in India. So just for revision purpose, we all are aware about that. But originally, the concept of valuation that was recognized under the wealth tax rule of 1957. So immediately after the independence, the concept of valuation was recognized. Wealth tax rules, as we are aware, the parent law provision is Income Tax Act. So under that, a provision for a valuation of unquoted shares and a company. So that was actually a purpose for which the provisions of valuations were brought into the Wealth Tax Act, and emphasis was given on book value method adjusted as per balance sheet, duly adjusted for a discount for marketability, a lack of a dividend, etc. Means mainly book value method was recognized in 1957. That was adjusted for the discount for marketability. We now recognize that discount as a discount for a lack of marketability, so discount for a marketability and a lack of a dividend, etc. So these rules were repealed effective from 1st of April 1989, and between 1990 and 1992, we had a fixed pricing guideline for valuation of share, which needed to be done as per erstwhile a company controller of a capital issue or a CCI guideline, which prescribed net asset value. So that is actually recognized under certain provisions of income tax even now, a net asset value, profit earning a capacity value, and a market value in case of a listed company. So as the value was based on historical, financial, and formula drives, resulted a value more or less it was a fixed. So whatever valuation estimation were arrived at based on these pricing guidelines, so estimate was fixed because that was a formula driven. So in 1992, a SEBI Act was made effective, and companies thereby were made free to price their own issues in consultation with the merchant bankers. So concept of merchant banker under a SEBI regulation that is continuing even now in 2023 also. And in 2010, between 2010 and March 2014, a DCF was prescribed by RBI for all FDI, foreign direct investment valuation, which was later changed to any internationally accepted method. So therefore, the importance of IBS that was recognized, IBS or International Valuation Standard. So that is continuing with the history of valuation. So in October 2009, a provision under Income Tax Act means onwards. So October 9 onwards, the provision for a transfer of share in ESOP tax, these were introduced as a perquisite, and law also prescribed a valuation of shares. So that was in 2019, and 1st of April 2016, as we are aware, the provisions of a Companies Act 2013 were made effective, but Section 247, which is relating to a valuation, that was finally made effective from October 2017 onward. And from 1st of April 2016, provisions under Ind AS effective from 1/4/16 means 1st of April 2016 onwards were made effective. So this is the brief history of valuation in India, and these are the law under which valuation is required. So we all are aware, Companies Act 2013, and then we have IBC 2016. Then we have Ind AS. So a question will come: who will do the valuation which is required under Ind AS or Indian Accounting Standard? So as we are aware, the a need for Ind AS, need for following the Ind AS or Indian Accounting Standard, that is recognized under the Companies Act. And a Companies Act lay down that wherever a valuation is required under any provisions of the Companies Act, so that will be done by a registered valuer. So indirectly, it is actually recognized that under Ind AS also, normally the valuation need to be done by a registered valuer. So that is the brief about Ind AS. And Income Tax Act 61. So it is done either by the chartered accountant, post accountant, merchant banker, or means in some provision it is registered valuer. And FEMA, so again it is merchant banker or chartered accountant, or some provision now actually the concept of registered valuer is getting recognized. And SEBI regulation, so it is not uniform. Somewhere it is a registered valuer, somewhere it is chartered accountant, somewhere it is a merchant banker. So the concept of registered valuer, that is not recognized uniformly under all the provisions of all acts. So that is the reality. And moving forward, so a need for valuation. So we all are aware, just to recap. So a regulatory, so that is Companies Act, IBC, SEBI regulation, FEMA regulation, IT and litigation matter. A transaction, so under for mergers and acquisition transaction, or for a business combination transaction, and a fundraising and investment transaction, a sale of business, purchase of business, or a voluntary assessment a transaction. And accounting, so a fair value under Ind AS, the purchase price allocation, so that is required in case of a business combination, or where there is a amalgamation between two company, or a merger between two company. So acquirer company that need to report the value, fair value of all the means all the asset of the acquiring company in its books of account, or in a financial statement at the fair value. So there actually a need for a valuation will be required for a purchase price allocation, and for employee stock option or ESOP, and for impairment, again a valuation is needed going by the guidelines provided in Ind AS. So the tangible and intangible asset are required to be tested for impairment at a periodical basis. Like goodwill, it is required at least once in a year, and other asset, whenever there are indicators, whether it is internal indicators or external indicators. So wherever there is indicators, so the assets will be tested for impairment. So this is the need for valuation in a brief. And this is just how to do valuation. Again, we all are aware. So it will start with understanding a purpose of valuation. then information will be gathered, required information, document details will be gathered, and the analysis of the financial statement or historical financial statement will be done. And the important is to make the normalization adjustment. So any company's financial statement that will contain certainly a certain abnormal item. So in evaluation, since that is a projection for a longer period, so the normalization adjustment need to be done before the finalizing the adjustment. And after that, understanding industry and characteristics and trend. So as we are aware, we in valuation, we recognize that there are three valuation approaches: market, income, and a cost approach. So similarly, globally or worldwide, there are 11 sectors which are recognized. So all the industries will fall under the umbrella of those 11 sectors, and under those 11 sectors, we will have around 50 industries, and under those 50 industry, we will have 150 plus sub industries, and all companies will fall under those 150 sub industry. So that is the actually broad hierarchy of each company. So you will appreciate that the characteristics of each sub industry or industry or a sector that will be different. And in making a valuation estimation, it is imperative that the valuer actually need to go through the characteristic. Means the classification, a sector-wise classification, that documents are available freely on internet. So if if that is needed, we can download any kind. So that will provide a very good knowledge on the sector-wise analysis. And after that, forecasting and validating a company performance, that we are aware. Forecasting again is a very important assignment because based on forecasting only, the final value will be estimated. So projections or forecasting, that is a very important exercise in any evaluation estimation. And thereafter, a consideration and application of appropriate valuation methodology. So as we are aware in this regard, IBS 104 and IBS 105, general standard IBS 104 and 105 are very important. So IBS 104, as we are aware, that is on a basis of value or a standard of value and a premise of value. And IBS 105 is on valuation approaches and methods. So this we can get guidance for selection of appropriate valuation methodology from IBS 104 and IBS 105. And finally, the last step will be the performing a value adjustment, a value conclusion, documentation, and finally the evaluation report. So this is the broad process of making evaluation estimate. And now we will start with the IBC provision. So what is the need for evaluation under IBC? So that is the core feature of a CIRP process. So without valuation, without correct valuation estimation, the success of any CIRP that will depend on correct valuation estimation. So that is the core feature or heart of any corporate insolvency resolution process, and that plays a very critical role in CIRP. Achieve objective of all stakeholders who are involved in that process, and evaluation is needed for computation of the value of asset of the corporate data, and accurate valuation that will play a crucial role in completion of various processes under IBC successfully. So as we are aware, IBC is a process-driven code. there are various processes which are listed under the IBC. So a success of those processes will largely depend on a correct valuation estimate. So moving forward, so we will start with the meaning of a fair value and a liquidation value. So that is the basic actually which is required in any valuation estimation. So as we are aware, the registered valuer or the RP or the resolution professional, he is duty bound to appoint a two registered valuer for valuation of the assets of the corporate debtor, and the the registered valuer are assigned the task of estimating a fair value and a liquidation value of the assets of the corporate debtor on the date of ICD, that is insolvency commencement date. So what is the meaning of fair value and what is the meaning of a liquidation value? That needs to be understood first. So as we are aware, in IBS 104, we will get a guidance on a basis of a value. So under IBS 104, there are some basis of value or a standard of value which are recognized and defined both. So there are six standards of value which are not only recognized under IBS 104, but the meaning of those standard is also provided in IBS 104. So apart from those six standard, there are some other standard which are recognized under IBS 104, but meaning of that we have to take from the respective document, means from where actually it is provided. So in these two, a fair value. So under IBS 104, the fair value is recognized as a standard of value, but the meaning of that we have to take from IFRS 13. So IFRS 13 is International Financial Reporting Standard 13, and in India, based on IFRS 13, we have Ind AS 113. So IFRS 13 and Ind AS 113, these are, as we are aware, for measurement of the fair value of asset. So a meaning of fair value, in other words, we have to take from IFRS 13 or the Ind AS 113. But 104, IBS 104, it specifically provides that wherever actually a meaning of some standard of value that is provided under a statutory law or the regulation, so that meaning will have upper hand. So if we go to a CIRP regulation, IBBI CIRP regulation, so there a meaning of fair value and a liquidation value that is provided. So we have to necessarily go by the meaning of a fair value and a liquidation value as per CIRP regulation whenever we are doing a valuation as under provisions of IBC at 2016. So that is the first information. And going forward, so as per regulation 21 HP of a CIRP regulation at 2016, the meaning of fair value is the estimated realizable value of the assets of the corporate debtor if they were to be exchanged on insolvency commencement date. So normally in a meaning of a standard of value or a basis of value, date of valuation is not specified. That date of valuation will be as per the terms and condition of the appointment between a valuer and his or its client. But in this regulation, a CIRP regulation, it is made mandatory that the valuation need to be done on the ICD or insolvency commencement date. So even if the valuer is appointed, say after 40 days or 50 days or 60 days after the commencement of insolvency, And in that scenario also, the valuation need to be done on ICD. So that is a very important. Between a willing buyer and a willing seller in arm's length transaction. So arm's length transaction, so that is a transaction between two unrelated party, and after a proper marketing and where the parties had acted knowledgeably, prudently, and without a compulsion. So more or less the meaning of this fair value, that is same as a meaning of a fair market value, which is provided under IBS 104, bearing a few amendment or a modification. And liquidation value, so that means estimated realizable value of the assets of the corporate debtor if the corporate debtor were to be liquidated on insolvency commencement date. So as we can see in both fair value and liquidation value, the registered valuer need to estimate the realizable value. So only difference is the in under a fair value, the realizable value needs to be ascertained by assuming that the corporate debtor will operate as a going concern in the foreseeable future. So that is the main difference under the fair value and liquidation value. So there actually assumption need to be made that the corporate debtor will undergo the process of winding up. So once these assumptions are made, naturally the value estimation will be different. So that is the difference between the net realizable value arrived at under a fair value standard of value, and the net estimated realizable value that is estimated under the standard of value of liquidation. So that is again a very important difference. And the meaning of fair value and liquidation value as per international valuation standard. So means as a registered valuer, we are now familiar with the fact that we will get the meaning of same terminology under a different document. So the meaning of fair value and liquidation value at we not only get from the CIRP regulation, but we will get a meaning of fair value and liquidation value from other important document as well. So under IVS or International Valuation Standard, the meaning of fair value that is actually as per IFRS 13. So as we are aware, IVSC or International Valuation Standard Committee and IFRS, that is International Financial Reporting Standard Committee, they have a tie-up actually. So wherever actually some important terminology is there, so that the terminology will be recognized under IVS, and a meaning of that need to be taken from IFRS. So in that case also, the meaning of a fair value, in this case also, the meaning of fair value needs to be taken from IFRS. So the meaning of fair value as per IFRS, that is the price that would be received to sell. So here actually, if we see the difference, here actually it is made received to sell. So that is the exit price and not the entry price. Received to sell means a seller whatever price he will receive, or whatever exit price will be received. To sell an asset or pay to transfer a liability in an orderly transaction between a market participant at the measurement date. So we have to remember that recognition of the fair value that is at a market price, not at a marketplace, not at a entity a specific price. So that is the difference. And a liquidation value, so that is the amount that would be realized when an asset or a group of assets are sold on a piecemeal basis. So that is the difference. Under a winding up process or under a liquidation process, it is assumed that, or assumption is made that the assets of the corporate debtor that needs to be sold on a piecemeal basis. So a liquidation value that need to take into account the cost of getting the asset into sellable condition as well as those of a disposal activity. When the company is going into winding up process, so it may happen that many of the assets are not in sellable condition because whatever may be the reason, like assets are in non-use for a considerable period. So to make that asset in a sellable condition, some cost will be required. So that needs to be considered under a liquidation value, and a cost of disposal that also needs to be taken into considered by the registered valuer. So amount that would be realized when an asset or a group of assets are sold on a piecemeal basis, and a liquidation value should take into account the cost of getting the asset into sellable condition as well as those of the disposal activity. And a liquidation value can be determined under two different premises of value. So that guidance we can get from IBS 104 again. These two premises of value are orderly transaction with a typical marketing period, or forced transaction with a shortened marketing period. So many times actually, because the assets are actually perishable in nature, that needs to be disposed of quickly. Otherwise, the quality of the asset may get deteriorated. That is the example of a forced transaction. So these are two premises under IBS 104 that is recognized in liquidation value. So orderly transaction and a forced transaction. So moving forward, now we will see the meaning as per ICAI valuation standard, meaning of fair value and liquidation value. So as we are aware, in India, Institute of Chartered Accountant of India, they have notified their own valuation standard. So going by meaning in that, so fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between a market participant at the valuation date. So as we can see from the previous slide, the meaning of fair value as per IFRS 13 and a meaning of fair value as per ICAI valuation standard, that is same. Reason being the meaning of fair value in IBS that is taken from IFRS 13, and based on that, Ind AS 13 is notified, and based on Ind AS 13, so a meaning of fair value under ICAI valuation standard that is taken from the Ind AS 113. So that is how these are same. And a liquidation value, so that is the amount that will be realized on a sale of an asset or a group of asset when actual or hypothetical termination of the business is contemplated or assumed. So either it is actual winding up process or it is hypothetical termination. So if we go to the meaning as per CIRP regulation, so there it is made clear that if the corporate debtor were to be liquidated, so that is not a real winding up process, that is assumed winding up process. So that is a hypothetical transaction. So that we need to understand. And moving forward, means a forced transaction. So that is premise of value. So going by ICAI valuation standard, the meaning of forced transaction, that is forced transaction is a transaction where a seller is under constraint to sell an asset without appropriate marketing period or efforts to market such asset. And orderly liquidation, that is an orderly liquidation, refers to the realizable value of an asset in the event of a liquidation after allowing appropriate marketing efforts and a reasonable period of time to market the asset on as-is basis. So that is as per ICAI valuation standard, and we can get a meaning of same these two fair value and orderly transaction from Ind AS 113 also. So going by Ind AS 113, price that would be received to sell an asset or paid to transfer a liability in an orderly transaction. So that, as we have discussed, the meaning of fair value under IFRS 13 or under Ind AS 113 or under ICAI valuation standard, that is same. And orderly transaction, so that is transaction assumes exposure to the market for a period before the measurement date to allow for marketing activity that are usual and customary for a transaction involving such asset and liability, and that is not a forced transaction. So that is actually the different meaning. So as a valuer, we need to understand the meaning of same terminology under a different document. So different document will give a different meaning. More or less it will be same, but some difference will be there. And that difference we need to understand, and we need to understand what is the purpose of making that difference, and that will help in a big way in arriving at projections and a final valuation estimation. So moving forward, the means there are two main processes, which is CIRP, corporate insolvency resolution process, and the liquidation process. So under a CIRP, a registered valuer need to ascertain a fair value and liquidation value. And under a liquidation process regulation, the registered valuer need to estimate the realizable value. So these are a different standard of value or a different basis of value which we need to understand. So moving forward, so these are the processes, and we have already discussed. The IBC is a process-driven act. So these are the processes under the IBC. So as we are aware, IBC is divided into. Just a minute. I will take just. So, as we have already discussed, the IBC is a process-driven act, and it is divided into different processes. And IBC, that is divided into 5 parts: part 1 and part 1 to part 5, and part 2 that is applicable to corporate persons. So corporate persons will include companies registered under Companies Act and LLP or a limited liability partnership incorporated under the Limited Liability Partnership Act. So mainly these are two corporate person, and under a part 2 of IBC, we have the processes of a CIRP, corporate insolvency resolution process, then a fast track CIRP or FTCIRP, that is applicable only to the specified corporate person. So that specified corporate person will include the small companies. What is the definition of small company? That is provided under the Companies Act. So this fast track CIRP that is applicable to the small company and the startup entities. So once this CIRP fails, then company will go into the liquidation process. So that is the third process. A fourth process is a voluntary liquidation process. So if any promoters of any company feels that going forward their profit may not be, their company may not be profitable, so they may opt for the voluntary liquidation. And that can be other reason also, but the company can itself opt for the voluntary liquidation, and provisions for a voluntary liquidation are incorporated under section 59 of IBC. So that is the fourth process. As we are aware, for a winding up of the company in India presently, there are 3 different processes. Number 1, a liquidation process under IBC. Number 2, voluntary liquidation process under IBC. And a third process is under Companies Act 2013. So that is winding up by a tribunal that provisions are there under Companies Act 2013. And a pre-packaged insolvency resolution process. This is the new development which is made immediately after the pandemic, COVID 2019. And this is applicable at present only to MSME unit. I'm sorry, just give me a minute. So, pre-packaged insolvency resolution process that is applicable mainly to the MSME unit, but now actually proposals are there to expand the scope of a pre-packaged insolvency resolution process. And under part 3 of IBC, so as we are aware, part 3 of IBC that is not made effective till today, that is even after 6 years of implementation of IBC, except for the personal guarantors to the corporate debtor. So part 3 of IBC that is not made effective except for the personal guarantors of the corporate debtor. So under part 3 of IBC, we have processes of fresh start process, insolvency resolution process, and a bankruptcy order. So under corporate person, we know it as a liquidation process. For individual, it is a bankruptcy process. So liquidation and bankruptcy, these are same actually. Meaning of that is same. And this is the broad overview. So flow of process. So we are aware corporate debtor committing a default. So when IBC was introduced in 2016, the threshold for a default that was as low as rupees 1 lakh. But after COVID 2019, the threshold was increased in March 2020 to 1 crore rupees. So if any corporate person, if it makes a default of 1 crore rupees, then application for commencement of CIRP can be filed before the adjudicating authority or the NCLT. And if it is admitted by the adjudicating authority, then a CIRP will be initiated. And if a CIRP will fail, then a liquidation process will start. So this is the flow process. And if we now move to particular regulation, so regulation 27 of CIRP regulation, so that is the main provision. So under that, actually, RP shall within 7 days of his appointment, but not later than a 47th day from the insolvency commencement date, appoint a registered valuer to determine a fair value and liquidation value of a corporate debtor in accordance with regulation 35. So here we can summarize this provision. Who will appoint the registered valuer? So registered professional will appoint. When a registered professional will appoint, so within 7 days, but not later than 47th day of his appointment, how many registered valuer will be appointed? So registered valuer. And as we are aware, in India, we have 3 different asset class. So in all, wherever a corporate debtor is having all 3 types of asset, so registered valuer, 6 registered valuer will be appointed. And what is the scope or what are the assignment of the registered valuer? So they will determine the fair value and liquidation value of the corporate debtor. So what is the meaning of fair value and liquidation value that we have seen in the previous slide? And the interim, so this is not related to our valuation. This is procedural in nature. So interim resolution professional or the resolution professional may appoint any professional in addition to registered valuer. So we will skip this. This is not related to the valuation. And who cannot be appointed as registered valuer? So that provision is made here. So a relative of the resolution professional, he cannot be appointed as a registered valuer. A related party of the corporate debtor an auditor of the corporate data at any time during the period of 5 years preceding the insolvency commencement date, and a partner or a director of the insolvency professional entity of which a resolution a professional is a partner or a director. So ins- uh, these are the disqualification, or these are the provision under which RP cannot be appointed. And this is regarding invoice and fee. So that actually any professional appointed under this regulation shall raise the invoice in the name of professional, and that needs to be paid directly in the bank account of such a professional. So that is regulation 27. And another important regulation, that is 35 of CIRP regulation. And going by that, the fair value and liquidation value need to be determined in the following manner. So a two registered valuer appointed under regulation 27 shall submit to RP an estimate of the fair value and of the liquidation value computed in accordance with internationally accepted valuation standards. So here again, it is highlighted that the fair value and the liquidation value need to be computed as per the guidance provided under the IBS, international evaluation standard, which are the internationally accepted evaluation standards. So that is the first condition. And a second condition is after a physical verification of the inventory and fixed assets of the corporate debtor. So that is the second condition. And as we are aware, in the past, actually a disciplinary authority or a disciplinary committee of the authority, or IBBI, they have issued a disciplinary order for making a valuation estimation without physical verification of the asset. So this is required as per the statutory law provision, and these needs to be done without any deviation. So wherever tangible assets are there, or wherever the corporate debtor is having inventory, so a valuation estimation need to be done only after a physical verification of the assets of the corporate debtor. So that is again a very important, because normally what happens, because of a competition or any reason, the professional fee or the remuneration which registered valuer get for valuation under IBC, that is a very low. And many times actually, in order to compete in the market, fees are actually quoted at such lower price that that is not sufficient for physical verification of assets of the corporate debtor, and particularly in cases where assets of the corporate debtor are at multiple locations. So actually we should make it a point to quote wherever a physical inspection is required, so that whatever a cost is there for a physical verification of asset, that needs to be charged at actual in addition to the professional fee. So that is means, but a deviation from this statutory law provision may get challenged at a later. So that is a very important. And if the two estimates of a value in an asset class are significantly different, so what is the meaning of significantly different? So a meaning of that was not provided earlier under the law provision, because the estimate will be provided by two registered valuer, and these two registered valuer will do the valuation independently. So when it is done independently, naturally there will be some difference. So here it is provided that where the estimate of a value in asset class, this is significantly different, or on a receipt of a proposal to appoint a third registered valuer from a COC or a committee of creditor. So this is also a latest development, a new amendment. The RP may appoint a third registered valuer for an asset class for submitting estimate of the value computed in a manner provided under A. So that is the requirement. And means what is the meaning of significantly different? So that was not provided here, but now Act is amended, and going by that, that means a difference of 25% in a liquidation value under an asset class. So if the difference is there in fair value, so that is not to be recognized, but when a difference is there in a liquidation value, so that there needs to be and if it is more than a 25%, then it will be considered as a significantly different, and the appointment of a third valuer for a particular asset class where a difference is more than 25%. So for that particular asset class, third valuer will be appointed. So the significantly different means a difference of 25% in a liquidation value under an asset class, and the same shall be calculated as L1 minus L2 divided by L1. So L1 is higher valuation of liquidation value, and L2 is a lower valuation of liquidation value. So higher valuation of liquidation value minus lower valuation of liquidation value divided by higher valuation of liquidation value. So that is the formula, and average of closest estimate of a value shall be considered the fair value or the liquidation value as the case may be. So once the third registered valuer is appointed, then average of means closest estimate of value that will be considered as the fair value. So moving forward, uh, uh, we have this regulation 35 of a CIRP regulation. So this is procedural in nature. So this we have already discussed 35. So after a resolution plans in accordance, so this is procedural. But the main is I would like to draw your attention here. A resolution professional and a registered valuer shall maintain a confidentiality of the fair value and liquidation value. So this is very important because in the past, going by the news report, it is alleged that actually the valuation estimation has been leaked in the market, and because of that, the realization is not as expected. So that is very important to maintain the confidentiality of the fair value and liquidation value. So moving forward, now we will go to regulation 32 of IBBI liquidation process regulation. So earlier actually there was means liquidation is what? Liquidation is to dispose of the assets of the corporate debtor, and whatever realization is there that needs to be distributed amongst the concerned stakeholder as per the water flow water flow chart which is provided under the law, or as per the priority which are assigned as per the law provision. So there was only a one note situation under which the assets of the corporate debtors were disposed of under a liquidation process. But now there are various scenarios as we can see. So a liquidator can sell the assets of the corporate debtor on a standalone basis, or assets in a slump sale. So what is the meaning of slump sale? That is not provided under IBC, but we can get a meaning of slump sale from Income Tax Act. So that is a asset in a slump sale, a set of asset collectively, the asset in a parcel. So the corporate debtor is a going concern. So previously it was not provided to sell the corporate debtor as a going concern. That was possible only under the CIRP regulation. But now even under liquidation regulation, the corporate debtor can be sold as a going concern basis, and the businesses of the corporate debtor is a going concern. So that is also now feasible if a corporate debtor that is a diversified company which is dealing in various types of business. So if any of the businesses of the corporate debtor that can be sold as a going concern. basis. So that is not feasible under a CIRP, but that is a feasible under the liquidation process regulation. That is to maximize the realization of the assets of the corporate debtor. That is the whole purpose. Why it is important? Because whenever a valuer will be appointed under liquidation process regulation, a valuer need to estimate the value taking this consideration. Means valuer will need to give estimation in a total six different scenarios. So six different scenarios are from A to F. Asset on a standalone or asset in a slump sale, asset a set of asset collectively, asset in parcel, a corporate debtor is a going concern. So under all this situation or scenario, the registered valuer need to estimate the value. So provided that where an asset is subject to a security interest, so many of the assets of the corporate debtor, it may happen that a charge is created against the asset. So whenever there is a security interest, so it shall not be sold under any of clauses of A to F unless a security interest therein has been relinquished to the liquidation estate. So that is the condition. So that needs to be ascertained by the registered valuer whenever appointed under a liquidation process regulation, whether any charge is created against the assets of the corporate debtor, and if charge is created, whether it is relinquished or not. If it is relinquished, then an estimate will be different, and if it is not relinquished, then estimate will be different. So that needs to be considered. And this moving forward at 32A. So this is the latest amendment, liquidation process, which provides sales as a going concern. So where the COC or committee of creditor has recommended sale under clause E or F of regulation 32, or where liquidator is of the opinion that a sale under E or F of regulation 32, a sale maximize the value of the corporate debtor. So E or F we have seen here, that is corporate debtor as a going concern and a business of the corporate debtor as a going concern. So that is 32 EF. So that provides that whenever a COC, either COC or the resolution professional, they are of the opinion that a sale under ENF of regulation 32 shall maximize the value of corporate debtor. So he shall endeavor to first sell under the said clauses. So in other words, clause A to D will not be applicable if the COC or a liquidator, if they are of the opinion that from E and F, the value of the corporate debtor will be maximized. So that is the precondition. And for the purpose of sale under sub-regulation 1, the group of asset and liability of the corporate debtor as identified by the committee of creditor under a sub-regulation 2 of regulation 39C of IBBI CIRP regulation. So that shall be sold as a going concern. So now actually this new regulation is incorporated under a CIRP regulation also. So at the time of recommendation for actually making a recommending a liquidation process for the corporate debtor, a COC needs to decide whether the under liquidation process the corporate debtor can be sold as a going concern. So that is again a very important, and where the committee of creditor has not identified asset or liability under sub-regulation 2 of 39C of IBBI CIRP regulation. So liquidator shall identify and group the asset and liability to be sold as a going concern in consultation with the consultation committee. So under CIRP, we know it as a COC, committee of creditor. Under a liquidation, that committee is known as the consultation committee. So that is again a very important. And if the liquidator is unable to sell a CD or its business under a clause E or F, regulation 32 within 90 days. So that outer limit is also specified. Any decision to sell the corporate debtor or any of the business of the corporate debtor that needs to be decided within 90 days from the liquidation commencement date, or LCD. So after that, the liquidator shall proceed to sell the asset of the corporate debtor as per A to D. So A to D is here, so that can be done. So first priority is to E to F, 90 days time, and then if it is not feasible, then these four situation or scenario, A to D. So that is what these new amendments are. And the valuation of asset intended to be sold. So this is under 35 IBBI liquidation regulation. So just give me a minute. So where the valuation has been conducted under regulation 35 of IBBI CIRP regulation. So that we have seen earlier. So this is regulation 35 of CIRP regulation. So wherever it is done or under a fast track CIRP, so as the case may be, so liquidator shall consider average of the estimate of the value arrived under those provision for the purpose of valuation under these regulations. So first priority or a first process for a liquidator is to recognize the average value of the estimated value which was arrived during the CIRP process. So that is the first process. And if not covered under regulation 1, or where the liquidator is of the opinion that a fresh valuation is required under the circumstances. So many times what happens that the CIRP process that goes on for 1 year, 2 year, so very long period. And at that time, earlier valuation estimate may become actually outdated due to a certain development. So as we are aware, we are presently living in the most uncertain time. So because of a certain development, if the valuation estimation which were done during CIRP, if that becomes outdated, so in that scenario, a liquidator may decide to appoint the fresh valuer. So when that needs to be done, that needs to be done within 7 days of the LCD or a liquidation commencement date. And again, a registered valuer will be appointed. And here it is to determine the realizable value of the asset. So here it is not the fair value of the asset or the liquidation value of the asset. Here it is the realizable value. So this needs to be understood by the registered valuer, the different requirement of valuation estimation. So moving forward, and this is actually common who cannot be appointed as a registered valuer. And moving forward, so appointment of a registered valuer. So this is a fast track, but before that, actually, this registered valuer appointed under sub-regulation 2. So here we have seen that is the second priority. So they shall independently submit to the liquidator the estimate of realizable value of the asset or a business, as the case may be, computed in accordance with a company's registered valuer and valuation. So here it is not internationally accepted valuation standard. Under IBBI CIRP regulation, we have seen that it is the internationally accepted valuation standard, but here actually it is companies registered valuer and valuation rule 2017. So that these difference also we need to actually recognize, we need to understand, or we need to consider at the time of evaluation. After a physical assets of verification of the assets of the corporate debtor. So again, that is actually highlighted. And the average of two estimate received under regulation 3, that shall be taken directly as the value of the assets of the that is what is highlighted. So under the liquidation regulation, the job of valuer, that is more wide actually. He need to ascertain these 6 types of different realizable value as per provision under company's registered valuer and valuation rule 2017. So this is a fast track CIRP regulation. So that is here the difference only now I will highlight. So here actually it is one registered valuer. So under CIRP and under liquidation, it is mandatory to appoint two registered valuer. But under a fast track CIRP, the only one registered valuer need to be appointed. So that difference we should understand or consider, and the means who cannot be appointed. So again that is same, and a fair value and liquidation value. So in fast track CIRP also, the valuer need to ascertain the fair value and liquidation value, and that is again as per internationally accepted valuation standard. So here it is not as per a company's registered valuer and valuation standard, but here again it is as per internationally accepted valuation standard. So these will make a difference, the difference standards of value or the basis of value, and a difference valuation standard. So that needs to be understood. And after a receipt of resolution plan, so that is again a same. So we will not go into a detail of that. And moving forward, a pre-package insolvency resolution process. So that is a new development. So law is amended it just in 2021. So going by that, actually, the resolution professional within 3 days of his appointment appoint a two registered valuer to determine the fair value and liquidation value of the corporate debtor. So again, under a pre-packaged IRP, it is not a net realizable value, it is a fair value and the liquidation value. And who cannot be appointed as registered valuer? So these provisions are same. So we will not go into detail of that. And here actually the fair value and liquidation value that need to be determined in the following manner. So a registered valuer appointed under regulation 38 shall submit to the RP estimate of the fair value and liquidation value computed in accordance with internationally accepted valuation standards. So at multiple places it is internationally accepted valuation standard, but in some places it is a company's registered valuer and valuation standard. So that difference we need to consider. And then actually here there is no provision for appointment of the third valuer. Directly average of the value determined by the registered valuer, that shall be considered the fair value and liquidation value as the case may be. So moving forward, now this is actually as we have already discussed the part 3 of the IBC, which is applicable to the individuals and partnership firm. That is not made applicable so far, but with the exception that it is applicable to the personal guarantors to the corporate debtor. So we have this regulation 30 of IBBI bankruptcy process for a personal guarantor at the corporate debtor regulation. And going by that, so a bankruptcy trustee shall appoint a registered valuer. So here there is no provision to appoint registered valuer. Here only one registered valuer will be appointed to value asset which may or may not form part of the bankrupt's estate when he is of the opinion that it is necessary or when a resolution to that effect has been passed by the committee. So there here only one. And another important is value the asset which may or may not form part of the bankrupt's estate. So in some actually asset, some litigation or title dispute is ongoing in a court of law, so that may not come to the estate of the bankrupt, that may come at a later date, but wherever some dispute is there, or whenever some ownership dispute or title dispute is ongoing, so a valuer need to actually estimate a value of both type of asset which are part of the bankrupt's estate or it is not part of the bankrupt's estate. So that is again a very important. And estimate of the net here again it is not fair value and liquidation value as we can see. So shall submit to the bankruptcy trustee estimate of the net realizable value of the assets computed in accordance with internationally accepted valuation standard. So under a liquidation process regulation, it is realizable value as per company's registered valuer and valuation rule. And as per a bankruptcy regulation, it is realizable value as per internationally accepted valuation standard. So these are different in a different regulation that we need to understand. And a bankruptcy trustee may appoint an additional registered valuer for valuing the assets of the bankrupt. If required in circumstances of the case, then independently submit his estimate as per sub-regulation 2. So whenever it is felt that the valuation from a second valuer independently is required, so that the bankruptcy trustee, he can appoint the second valuer also. And the reserve price shall be a value shall be the value of asset arrived at in accordance with regulation 30, and such valuation shall not be more than a 6 month end. So we actually frequently come across a question: what is the validity of the valuation report? So validity of the valuation report, that is on the date of the valuation, but actually here under this regulation, it is specifically provided that whatever reserve price is arrived at based on the valuation estimation submitted by the registered valuer, so that will remain valid for a period of 6 months. So that is indirectly the validity of the valuation report is provided here, so that we need to consider. And this is a procedural in part, so we will not go into detail of that. And moving forward, so this is a summary of provision concerning the evaluation under IBC. So what we have discussed so far, that I have actually present in a summarized manner. So we can go through these. So in all, there are 8 situations where actually the evaluation is required. So with that, actually, we have completed our first part, evaluation under IBC 2016. And before we move on to our second part, valuation under Companies Act. So any questions on whatever we have covered so far, or can we move forward to our second part? Any questions on whatever we have covered so far, or can we move forward to our second part?
Sir, I have one question regarding the liquidation value.
Yes, please go ahead, sir.
So can you tell us the practical aspect of how much the difference between in practical in liquidation value and the fair values? Say 50%, 70%, 60%, whatever it will be. And what was the aspects for backing for this?
So, sir, that cannot be generalized in a manner. Actually, you are telling the what can be the difference of whether it is a 50% or a 70%. But again, I will highlight here actually in a liquidation value what you need to consider means that is this is a main important. Just give me a minute. So this is a very important liquidation value, the amount that would be realized when an asset or group of asset. So here there are 2 provisions. See, under a fair value, the assumption is the corporate debtor will be sold as a going concern. So no question of selling assets of the corporate debtor in a piecemeal basis. So you will appreciate that when a company or business entity is sold as a going concern, so naturally the value of that will be more than the value of asset when they are sold on a piecemeal basis. So that is the basic difference. That is difference number one. So amount would be realized when an asset or group of asset are sold on a piecemeal basis. And another important difference is, so liquidation value should take into account the cost of getting asset into sellable condition. So that a particular provision is not there under fair value. So these value naturally you will estimate and reduce. So that is the cost of getting the asset into sellable condition, and this will be different in each scenario. You will appreciate that. And difference number three, the disposal activity. So what will be the cost of disposal of assets of the corporate debtor? So that also needs to be reduced. So this is the reason why a fair value is more than the liquidation value. Now, how much difference will be there, that you will appreciate, sir, that will be different in each scenario, in each assignment. That cannot be generalized. So that needs to be estimated by the valuer based on his expertise in the field, or based on his estimation, sir. So that is, sir, my understanding about this.
Okay, sir. Thank you very much.
So second question is, can you share any PDF of a complete report of land and building valuation? What I suggest, sir, I'm not aware whether you have downloaded it or not. So particularly for land and building valuation, the blue book of valuation, that is European standards on valuation, that is providing a very good guidance, and that is available freely on the internet. And there you will get a pro forma of the valuation report for a land and building valuation. So that I found is very useful. That is one source document. Another source document is the red book of valuation. So red book of valuation, as we all are aware, that is published by the institute in UK, London, RVIC. So that you can consider downloading. That is also available free of cost on internet. And apart from that, USA appraisal standard, because in the America and European country, you will get mainly a valuation guidance relating to land and building. So there also, in their standard also, you will get pro forma of the valuation report. So based on that, sir, you can customize your valuation report. There you will get a good guidance. So I hope it is clear. Sir, shall we get any case study on liquidation for a reference? So case study in which sense? What exactly you mean to say by this, Siba? Case study?
Sir, for reference, how we are calculating this liquidation value, etc.
Okay. So are you aware, madam, actually the ICAI RVO, that is Institute of Chartered Accountant of India, RVO, they have published guidance on this. So that you can download from the internet. It is available free of cost, particularly for SFA. That guidance is for SFA, securities or financial asset. So there you will get, because see, for SFA, according to me, it is more challenging because plant and machinery and land and building, I am not saying it is less challenging, but at least these assets are in physical form, whereas in case of SFA, assets are like intangible asset. So they do not, these assets are not having physical form, and other financial assets like trade receivable and all. So again, that is not having physical form. So that is very challenging. And on that, actually, ICAI RBO has published one guidance note. So that you consider downloading it if you are from SFA class, madam.
Okay.
So any further questions, or can we move ahead to our second part? So if no questions, then we can move ahead to the second part. Now, Companies Act actually that is means valuation requirement actually divided into three parts. Some actually the transaction will have a requirement as per provisions of Companies Act. Some transaction will have a requirement of valuation as per SEBI regulation. Some transaction will have a valuation requirement as per FEMA regulation. If that is related to the countries other than India, or if those transactions are relating to the countries outside India. So this actually is divided into three parts. So here we will cover only under the provisions of Companies Act. We are not going to cover the valuation requirement as per SEBI regulation and valuation requirement as per the FEMA regulation. So as we are aware, for a listed entity, the companies which are listed on the stock exchanges, so they need to comply the SEBI regulation. And the companies who are non-listed, so they need to comply the companies rules actually. So we will cover the provisions of the Companies Act and relevant rules means companies rules. So that is what coverage of these will be. And moving forward, so these are the important situation or activity under Companies Act 2013 where evaluation is needed. So that is needed for issue of shares for consideration other than cash valuation of consideration, then issue of short equity share, measurement of the fair price, issue of shares including ESOP, employee stock option, and the right issue, valuation of asset provided as a security, non-cash transaction involving director, a compromise or arrangement amongst the creditors or a shareholder, mergers and amalgamation, acquisition of minority stake, and evaluation of asset at the time of winding up of a company. So these are the situation or activities where the evaluation is needed as per a Companies Act 2013. So we will start with a further issue of shares, a preferential allotment, provisions of which are covered under section 62 of the Companies Act 2013. So before we do that, what I propose, can we have a small break of just 2 minutes? So if it is convenient, we will resume the session after just 2 minutes. So please bear with me for 2 minutes. We will resume a session in just 2 minutes. So can we start now? I hope each one of you have rejoined. So just give me a minute. I will again take you through this PPT. And meantime, there is a message in the chat box. So kindly share case study of a company evaluation. So I am having actually the evaluation reports of SEBI regulation or company regulation. So what I will try to do at the end of this session, I will try to locate that from my laptop, and I will share that. If I fail to do so, definitely I will share with the organizer of this event, and in turn you will get that. So I hope no further questions on that, Radhakrishnan sir. So I hope that is clear. So means further issue of shares, that is a preferential allotment. So many time actually a registered valuer get assignment under these provision for a preferential allotment. So where at any time a company having a share capital proposed to increase its subscribed capital by the issue of further share, such share shall be offered. So first actually person who at the date of offer are holders of equity shares of the company. So that is the right share. So first actually the any means a company actually decide to increase its subscribed capital. So first chance will be given to the existing shareholder, and that is what a right shares is. So that is what is provided here, as nearly as circumstances admit to the paid up share capital on those share by sending a letter of offer subject to the following condition. So the offer shall be made by a notice specifying the number of shares offered and limiting a time not being less than 15 days. So this is just procedural in nature. So that is not relevant to our evaluation profession. That is the that is the procedural in nature. So any message in the chat box? So my name is not found in the list of participants. Okay, the organizer will do the needful. So whenever any additional shares are issued by the company, so that first needs to be given to the existing shareholder as a right issue. And what is the procedure for that? So that is actually highlighted here or incorporated here. And if it is not exercised by the existing shareholder, so after expiry of the time specified in the notice, or on a receipt of earlier intimation from the person to whom such a notice is given, that he declines to accept the shares offer. So in that scenario, so a board of director may dispose of them in such manner which is not disadvantageous to the shareholder of the company. So how it will be disposed of? So if existing shareholder, they are actually not accepting the offer of the additional share, so first that will be given to the employees under a scheme of employee stock option, subject to special resolution passed by a company, and subject to such condition as may be prescribed. So once it is prescribed, we have to refer to the relevant rule, and to any person means other than the existing shareholder and the employees of the company. So now actually the promoter or director of the company will get a chance to issue the shares to any other person, and that is what a preferential allotment is. And so to any person, if it is authorized by a special resolution, whether or not those person include the person referred to in clause A. So clause A we just covered existing shareholder, or a clause B, so that is the employees. So that we also covered either for case or for a consideration other than case. So shares can be issued both. Consideration can be case or in kind also. And if the price of such share is determined by a valuation report of a registered valuer. So here actually a valuation needs to be obtained from a registered valuer, and subject to compliance with the applicable provision of chapter 3 and any other condition as may be prescribed. So that is the relevant provision under a Companies Act for a preferential allotment of shares. And this is the relevant rule. So wherever we have seen as maybe a prescribed. So prescribed, we have to refer to the relevant rule. So that is a rule 30 of a share capital and a debenture rule, issue of shares on a preferential basis. So for convenience, what I have done, I have also incorporated the relevant rules here. So for the purpose of clause C, so clause C we have just seen, this is the clause. So a clause C of subsection 1 of section 62. So this is the clause C of subsection 1 of section 62. So that we have just seen. So for the purpose of clause C of subsection 1 of section 62, if authorized by a special resolution passed in a general meeting, shares may be issued by any company in any manner whatsoever, including by way of preferential offer to person, whether or not those person include person referred to in clause A. So clause A we have already seen existing shareholder, and clause B. So clause B we have already seen employees of subsection 1 of section 62. And such issue on a preferential basis should also comply with condition which is laid down under section 42 of the Act. So that is the relevant rule provision. Now we will not go into a detail of each provision. About we will refer just what I have highlighted in bold. So that is relevant. So provided further that the price of share to be issued on a preferential basis by a listed company shall not be required to be determined by the valuation report of a registered valuer. So as I informed you, wherever a company is listed, so there actually SEBI regulation needs to be complied with, not these companies' share capital and debenture rules of 2014. So under SEBI regulation, actually the provision is a valuation by a SEBI approved merchant banker, not by a registered valuer. So that is important. For a listed company, these rules are not applicable. So in other words, these rules are applicable only for the unlisted company or a non-listed company. So moving forward, these are the condition, and this is where the preferential offer of shares or other securities are made by a company whose share or other security are listed on a recognized stock exchange. So such a preferential offer shall be made in accordance with the provisions of the Act and a regulation made by a SEBI. So as I informed you, SEBI regulation will be applicable. And if they are not listed, so a preferential offer shall be as per provisions of the Act and rules made hereunder and subject to compliance with the following requirement. So one of the requirement is basis on which the price has been arrived at, along with a report of the registered valuer. So these actually the requirement needs to be complied by the board of directors of the company, and they need to justify the basis at which basis on which the price has been arrived at. So very important for the valuer to incorporate the details of basis of price in the evaluation report. So that is rule 30. And moving forward, so again we will just go through the highlighted portion. So justification for the allotment proposed to be made for consideration other than case, together with valuation report of the registered valuer. So wherever actually the shares are issued for consideration in kind, means supposing the shareholder proposes to give, the prospective shareholder proposes to give some tangible asset like a building or land, plot of land, etc. So in that case, actually a valuation of that a plot of land or a building or a plant and machinery, that also needs to be done by a registered valuer. So it is not that under companies act or rules made there under a valuation is required from only a SFA valuer, but it is also required from plant and machinery valuer and land and building valuer whenever it is necessary or whenever it is imperative. So that is the rule 13. And moving forward, so here again we will move to only highlighted a portion. The the price of the share or other security to be issued on a preferential basis. So this preferential basis, it is not that only shares can be issued. Other security like a bond or a debenture or a preferential shares that can also be issued. Other security issued on a preferential basis, either for case or for consideration other than case, shall be determined on the basis of valuation report of a registered valuer. So again, it is highlighted to obtain the valuation report from a registered valuer. And at the time which shall not be earlier than 30 days to the date when the holder of convertible security becomes entitled to apply for share on the basis of a valuation report of the registered valuer, given not earlier than 60 days of the date when the holder of convertible security becomes entitled to apply for the share. So many times actually companies allot a convertible security like convertible debentures or a convertible bonds, etc. So in such scenario, actually a valuation also will be required 30 days to the date when the holder of convertible security becomes entitled to apply for shares. So that is another provision. And where shares or other security are to be allotted for consideration other than case, so a valuation of such consideration shall be done again by a registered valuer, who shall submit a valuation report to the company giving a justification for the valuation. So here, other than consideration, so naturally it will fall in the domain of the land and building valuer or the plant and machinery valuer. So that is again important. And moving forward, this explanation is important. So for the purpose of this rule, it is hereby clarified that till a registered valuer is appointed in accordance with provisions of the Act. So now it has become outdated because now actually because this is the original provision when Companies Act 2013 was implemented in India. At that time, actually, as we discussed, Section 247 of Companies Act was not notified. So once it is notified, now we have sufficient number of registered valuer, but this provision is still not deleted from the Companies Act. So for the purpose of this rule, it is hereby clarified that till a registered valuer is appointed in accordance with provisions of the Act, so a valuation report shall be made by an independent merchant banker who is registered with SEBI or an independent chartered accountant in practice having a minimum experience of 10 years. So going according to me, now this has become outdated. Same there is a registered valuer now. So the price of shares or other security to be issued on preferential basis shall not be less than the price determined on the basis of a valuation report of a registered valuer. So here actually the provision is it should not be issued at a price less than the price determined on the basis of valuation report. So in other words, it can be issued at a price higher than the price determined by the registered valuer. But it should not be issued at a price which is less than the price which is determined by the registered valuer. That is again a very important. And moving forward, so we have this another provision, section 192 of Companies Act, which is on a restriction on a non-case transaction involving a director. So actually, a director means if any transaction is there between directors and the company, which are in a non-case, means in not in monetary terms. So there actually the I will again highlight this highlighted portion. So notice for approval of the resolution by a company or holding company in a general meeting under subsection 1 shall include particulars of the arrangement along with the value of the asset involved in such arrangement duly calculated by a registered valuer. So supposing there is a transaction of a non-cash in nature between company and director, like a director giving its building to the company, or a company giving its building to the director. That is just one example. There can be many such examples. So in that scenario, full details of that arrangement needs to be disclosed, number one. And number two, a value of that asset needs to be determined by a registered valuer. So that is what is highlighted, a restriction on non-cash transaction involving a director. So then we have these provision important. So company or any other person by whom application is made under section 1 shall disclose to the tribunal by affidavit. So this affidavit needs to be filed to the tribunal or NCLT, National Company Law Tribunal. And one of the items in that is valuation report in respect of the shares and property and all asset, tangible, intangible, movable, immovable of the company by a registered valuer. So this is applicable where a power to compromise or make arrangement with creditors and a member. So this is the third provision, that is a section 230, subsection 2 of section 230 of Companies Act 2013. So this is again here also all types of assets are covered, tangible, intangible, movable, immovable of the company by a registered valuer. So here again there is a scope for evaluation by all three asset class, that is plant and machinery, land and building, and SFA. So this is again a very important 232 of Companies Act 2013. So this is actually moving forward where the meeting is proposed to be called in a pursuance of order of the tribunal under a subsection 1. So notice of such meeting sent. This is the procedural in nature. So we will skip that, and we will move to now rule 6 of a company's compromise arrangement and amalgamation. So this set of rule is different. Earlier about we had seen that rules were actually share capital and debenture rules. So here there is a altogether different set of rules. So that needs to be actually downloaded. Compromise arrangement and amalgamation of 2016. So there actually this is very important going by the rule 6. So summary of valuation report if applicable, including a basis of valuation. So under provisions of the Companies Act, the need for incorporating a basis of value in the valuation report is highlighted at all the places. So very important, including a basis of valuation and a fairness opinion of the registered valuer, if any, and the declaration that a valuation report is available for inspection at a registered office of the company. So very big responsibility on the registered valuer, on the shoulders of the registered valuer, because the valuation report issued by the RV is kept for a public inspection at the registered office of the company. So for companies, it is not a private document; it is a public document. So accordingly, we need to exercise a due care in estimation. So that is again a very important. And a valuation report shall be made by a registered valuer, and till the time. So again, this is outdated provision as we have discussed. Stopgap arrangement is independent merchant banker and independent chartered accountant. So that is not there because now registered valuers are there. Now we will go to next provision, section 232 of Companies Act. So that is merger and amalgamation of company. So that actually a procedural in a part only we will go. So highlighted a portion. So provided that amount of payment or valuation under these clause for any share shall not be less than what has been specified by the SEBI under any regulation framed by it. So here it is not by registered valuer. It is here it is by a SEBI regulation. That is again a very important. Section 32, mergers and amalgamation of the company. Then we have this section 281, submission of report by a company liquidator. There actually we will again go just highlighted a portion. So provided that a valuation of the assets shall be obtained from a registered valuer for these purpose. So as we discussed, for winding up of the company or a liquidation of the company, there are three opportunities. There are three avenues in India today. Two are under IBC and one under a Companies Act. So that is a company liquidator. Here it is not the liquidator appointed under IBC. So a company liquidator also needs to take a valuation estimation from a registered valuer. And we have this section 39, which is related to allotment of security by company. That is again, this is very important. The such time and manner as may be prescribed. So that prescribed means we have to refer to the relevant. That is again we will go to that relevant tool, but prior to that, whenever a company having a share capital makes an allotment of security, it shall file with the registrar a return of allotment in such manner as may be prescribed. So that is again we have to refer to the relevant tools, and this is a relevant tool. So here, as you can see, this is altogether a different set of rule. So here we have referred to the prospectus and allotment of security rules of 2014. So that is on a return on allotment. So here again we will go through this highlighted portion. So a report of a registered valuer in respect of valuation of the consideration shall also be attached along with the contract as mentioned in sub-rule 3 and sub-rule 4. So sub-rule 3 and sub-rule 4 is here. So along with these compliance, a report of registered valuer need to be attached actually. So that is rule 12 of company's prospectus and allotment of security rules. And moving forward, so this is issue of short equity shares. So that is issued by the company to its employee. So provisions are under section 54. So again, we will go to the highlighted portion. So where the equity shares of the company are listed on a recognized stock exchange, short equity shares are issued in accordance with a regulation made by the SEBI. So SEBI regulations are applicable to the listed company. And if they are not listed, short equity shares are issued in accordance with such rules as may be prescribed. So prescribed means always it is the rules which are notified by the government. So that is very important. And this is a rule 8 of share capital and a debenture rule. So here again we are referring to same set of rules, share capital and a debenture rule, issue of short equity share. So a company other than a listed company which is not required to comply with this SEBI regulation on a short equity shall not issue a short equity share a director or employee at a discount or for a consideration other than cash. So here it can be issued only for a case basis, not for a consideration other than cash. So that is important for their providing know-how or making available rights in the nature of intellectual property right. So IPR or intellectual property right, as we are aware, that is consisting of patents, trademark, copyrights, etc. So if it is provided by the, to the company or a value addition by whatever name code, unless the issue is authorized by a special resolution passed by the company in a general meeting. So that is a issue of short equity. And moving forward, this is a rule, same rule. So here actually we will again refer to this highlighted portion. So the principal terms and condition on which short equity shares are to be issued, including a basis of valuation. So again, a very important basis of valuation. Here, a valuation report will be issued by the registered valuer. And here again, a very important, short equity shares to be issued shall be valued at a price determined by a registered valuer as a fair price, giving justification for such valuation. So to arriving at a fair price, valuer need to provide the justification. And a valuation of intellectual property right. Intellectual property right, as we are discussed, mainly it is in the form of a patents, trademark, or a copyright. But there are other type of IPR also, intellectual property right. So that is a valuation of IPR or of know-how or a value addition for which short equity shares are to be issued. So that shall be carried out by a registered valuer who shall provide a proper report addressed to the board of director with justification for such valuation. And a copy of gist along with the critical element of the valuation report obtained under these sub rule 6 and clause 7. So that shall be sent to the shareholder with notice of a general meeting. So that is the important provision. And moving forward, so as per the again here same rule as per the valuation report shall be treated as a form of compensation to the employee or the director in the financial statements of the company. So like that we have this restriction on purchase by company or a giving of loan by its by it for a purchase of share. So there also a requirement of valuation by a registered valuer is there. And a relevant rule of that is Rule 16, share capital and a debenture. So that is relating to provision of money by company for a purchase of its own share by employee or a trustee for the benefit of an employee. So as we are aware, for ESOP actually, companies are creating trust. So here both are covered, own shares to employee or the trustees for the benefit of employee. So trustees of the trust, which is constituted for the benefit of the employees. And this is acceptance of a deposit rule 2014. So there also a valuation is required from a registered valuer. And another is a purchase of minority shareholder. So there also the price determined on the basis of valuation by a registered valuer in accordance with such rule as may be prescribed. And such rule is Rule 27 of compromise arrangement and amalgamation. It's a determination of price for a purchase of minority shareholder. So a different rules are applicable for a different provision, and here it is duties of the company administrator. So there also a valuation report is required, and this is just for a convenience. I have also provided a summary of provision concerning valuation under Companies Act 2013. So as we can see in all, there are actually 11 situation or a scenario. So what I have done, I have not only actually incorporated the relevant provision under Companies Act, but I have also incorporated the relevant rules. So generally we find it difficult to actually go through the rules because that is actually tedious process. So for convenience in these PPT, I have incorporated the relevant rules also. So with that, actually, from my side, it is over in a limited time of 2 hours on this vast subject, because valuation under IBC and Companies Act, as we all are aware, that has got its own challenges. And I thank each one of you for your attention throughout the session and making it interactive. And I may add that actually I am having a viral infection from last 2 days, but since I had committed for this long time back, so I had made my commitment, and because of that, if you have experienced any any difficulty, so I please excuse me for that. In case you have actually experienced any inconvenience, so please excuse me for that. And thank you very much. Thank you, sir, Nitin ji, Ramesh ji, for your kind word, Sanjay ji, for your kind words. through the chat box messages. And before we finally conclude our today's session, so any question from your side on whatever we covered today? Any question? And this PPT I will definitely share with the organizer of this event, and in turn you will definitely get that. So that be assured, I will share that PPT with the organizer. So apart from that, any question? Thank you, sir. Thank you. So it is a Sunday, and your family must be waiting for a lunch. So if no question, then we will conclude because our family should not actually put to inconvenience because of our this academic pursuit. So we will end here, and I will now hand over to organizer of this event.
Thank you, sir.
Thank you. Thank you.
So we are coming to the end of this CEP. Thank you, Chatwani sir, for associating with us and taking this assignment and covering the topic very nicely and very clearly. Thank you, participants, for participating with us, participating in this CEP. I would have liked that you could have interacted a little bit more, some more questions, but anyway, thank you very much. Please share your feedback. Some of you have already done. Thank you for your positive feedback. Thank you very much. Thank you, Kajal. Thank you, sir. Thank you, sir.
Thank you.
Thank you.